This is Ant Lyons, editor of Your Property Network magazine. On the call this morning, I'd like to welcome Jane Owen once again. Jane, our regular writer, and turns everything we do here in YPN into the magnificent articles that we see in the pages. And we're also joined by some really good friends of mine in property. Jess Fossey-Taylor. Morning, Jess. How are you doing?
Morning. Hi there.
And we've got Dan and Colin from Pulse Property. Guys, give us a wave.
Morning, Dan. Morning. Hi there.
Okay, so we've had some technical challenges getting online this morning, so I hope if anybody's watching this one, it's going to go smoother than the previous outtake ones that we've already got recorded. But this morning we're going to be talking about investing in Nottingham, and this is part of a series of articles that we do in looking at individual towns and cities, talking to people who really invest there and getting a feel for the city, what works, why it works, what doesn't work, and the reasons for that. So, Jess, first of all, I'm going to get some of your experience. And Jess, you've been investing in Nottingham for how long?
7 years now, Anne. Been investing in about 7 years. Not always like we have been doing now. It was a little bit lower key before that, but about 7 years. So.
Okay, brilliant. And a lot of the readers of YPN will know you for being involved in, well, your bread and butter really is fairly bread and butter investments. You know, the backbone of your portfolio is probably made up of single lets where you've bought, added value, and then, you know, forced the appreciation of that asset and then been able to refinance. Is that an accurate statement?
Yeah, definitely true to say. I think it wasn't really, not necessarily through choice originally. When I first started buying property, it wasn't what I was buying. It wasn't really something I had much knowledge about. I started buying commercial property because I had a business that operated from commercial premises. I bought a number of different types of properties. In the 2005-06, even a little bit before that, I was buying flats in Northampton. It was only when the crash happened that pretty much every other type of property started looking either a little bit unattractive or I couldn't finance it. For one reason or another, it was the 2 or 3 bedroom family house that just kept working. So that's why I've concentrated on buying those out. There's a lot of them in Nottingham, and it's worked for the last 5, 6, 7 years very, very well. I'm sure now we're peaking out the other side of the recession. I think there's probably some opportunities elsewhere as well, but I can't see that a 2 or 3 bed family house is going to stop. Families aren't going to go. Yeah, the families isn't going to stop. People will always need family homes, and they're affordable family homes. Nottingham is the 6th biggest city in the UK, and it's growing at the 2nd fastest rate. So I think that we've got a very stable base to build on in Nottingham.
Okay, brilliant. And we're going to talk about some of the other opportunities going forward. And just to really consider the alternative as well, and we're going to be going into more detail in both of your strategies in a minute. Dan and Colin, your investments are slightly different, aren't they? You focus less on the sort of single-let properties for your own portfolio and perhaps... Okay, we've lost the guys for a second. We'll just see if we can get them back on.
Sure, they'll come back.
We're going back. Hi guys, sorry, we lost you there for a second. We were just saying that your portfolios are built up more on the sort of multi-let side of things, is that right?
Yeah, certainly. We invest in HMOs, multi-lets. We do that for students and professionals in Nottingham. We've been investing here for about a year and a half, 18 months.
Right. Okay. So 2 very different markets in the one town. Jess has given us an indication of why the single let model of family homes works, because families are never going out of fashion. Jess, can you talk us through a very typical buy, add value, refinance deal that you would look at either for yourself or a client in Nottingham and the kind of numbers behind that?
Really simply, anywhere from 40 to 60 as a purchase price, anywhere from 5 to 15 as a refurb, and 70 to 90 as an end value. They all rent out for roughly the same, so you've got a rental value of somewhere between 475 and 550 for any of those properties. So it's a really good natural yield, just the numbers, even if you were to buy them at the top end, the natural yields are pretty good. Very stable refinance position, so it just works. We've done lots and lots of those deals, so we know that the refinance it comes in at that level. The slight, I guess, decision for a client of ours, and what they usually decide is have a bit of everything, is do they go for the really cheap ones, which have got a higher yield. We're looking at about 525 rents on a 50 grand house, or all the way up to £90,000, and they're still getting the same rent, and so the yield's less. The percentage they've made on an uplift is the same, but the percentage means more cash, if you like. It's easier to get your cash out if that's something you want to do on a recycling basis. On something that's a little bit more expensive, it's quite hard to refinance all your cash out if you're not working with a particularly valuable property. It's a trade-off. You get ever so slightly lesser yield, although it's still good, but you get more of your cash out, or you get a really good yield, even better than sort of 10, 11, 12%, but maybe you're leaving £5,000, £6,000, £7,000 in the property. So, yeah, that's a very standard bread and butter deal, as we call it.
Okay, brilliant. And how many of those types of deals have you been involved in the Nottingham area?
A couple of hundred, maybe. It must be getting close to 300 by now.
Okay, brilliant. Okay, fantastic. And I'd like to ask you both now, what is going on in the market at the moment? So, Jess, first of all, we keep hearing all this positivity in the mainstream press about how prices are going up everywhere. What's happening in Nottingham on those types of properties right now?
They are getting harder to buy for us. People are paying more money, only £2,000, £3,000, £4,000 more from a year and a half, 2 years ago, but that's quite a big percentage. There are more people interested in buying them, so we have to work harder and put our feelers out into the market more, spend more time looking for them. I do get the feeling that the market's moving. It's always one of those things. It's not imperceptible, but it does creep up on you. Last year, apparently, this is the figures I read, Nottingham experienced 3.5 to 4, depending on which report you read, 3.5 to 4% growth. If you look back, it probably did actually. It didn't really feel like it at the time, but that's one of the highest rates of growth in the UK right now. Not massive, right? I know that, but it does feel like things are moving. You walk into the estate agent where they used to have empty desks around the room. They've taken on new staff. The phones are ringing.
And are you seeing, you're seeing a lot more stuff having been sold, the sort of sold subject to contract stuff come up on Rightmove and sold signs coming up around the town?
Yeah. Yes, we are. It's still not. It's better than it was a year ago, but it was at an all-time low a year ago. So it's not massive, but it is a difference, and it is going the right way. And I think it is weighted towards the kind of properties we buy. So investors are out there in force rather than first-time buyers, perhaps, and they're after the 50, 60, 70,000 pound houses, and that's making what we buy a more competitive market. It's good for our clients and ourselves that we've bought stuff over the last year, 2 years, and they're really starting to go up now. There was a period where, about a year or so ago, we bought so many of these places in quite small, defined areas, and not many other people had. Only really investors had bought them, and we'd all been buying them at 40, 50, 60,000 pounds. You now try and convince a surveyor that it's going to be worth 80 or 90,000 pounds. That became quite a tough challenge. On a street of maybe 100 properties, and we've bought 10 of them, all for 50,000 pounds, and nobody else bought anything else on the street. The new market price becomes pretty much what we've paid. We've come out the other side of that now, and there are some. We always knew that there were real retail clients. People who are going to live in the property. buying them for 80s and 85s, but not very many of them. So when the surveyors want to put their comparables down, they were struggling to find them. But now we are seeing more. It's something we keep an eye on, more comparables as we call them. That is an owner-occupier buying the property to live in, and they're buying it at the 85,000, which is near peak actually, near 2008, nearly, not quite, but nearly. So that's really good for our comparables, but it does make it harder buying them at the other end. But
yeah,
that's our problem. We've got to.
That's the game you're in, hey.
Exactly. Well, I always believe that our business, it's not just. Our business wasn't set up to just buy these types of properties. It was set up to find the type of property that you should be buying right now. This is going to be an interesting discussion because I haven't bought an HMO for 6-7 years. The last 3 that I bought, I had to leave about £60,000-70,000 in each one of them. I didn't mean to. I meant to pull it out. I just couldn't find the refinance to do it. And a big part of what I want to do is always recycle my deposit as much as I possibly can. And for that reason, I stopped buying HMOs. But long term, I think there's always a reason to be buying property. As Ossie Taylor, we have to find what that property is, and I'm sure it's going to move over the next 2, 3, 4, 5, 25 years, you know. And it's our job to just keep finding the angle and find that margin so that there's a good reason to buy it, and we can also make it a sustainable business by refinancing it if that's all our clients don't want to refinance, but I do. So.
Okay, brilliant. Dan and Colin, you're a bit pixelated on the screen. Can you guys hear me okay?
Yeah, we can hear you. It's slightly broken, but we've got a line.
Okay, great. Well, guys, I wanted to talk to you very specifically about the student market for a moment, because we've done a number of these discussions now in different towns and cities, and there's been a common theme actually in all of those, and that is that the student market in the other areas that we've been discussing has changed quite dramatically in the last year and a half to 2 years. And unless the properties are in absolutely the sort of premium student location, investors are struggling to let them now. Maybe the number of enrolments in the universities has fallen back a little bit. There's increased competition from universities building their own bespoke accommodation, which perhaps appeals to overseas students, where, you know, a lot more high proportion of their students are coming from. So I wondered if you could tell us a little bit about the student market in Nottingham and what your experience has been so far.
Yeah, of course. I think a couple of things that are worth confirming are the 2 different investment models. So we're both invested in Nottingham. A couple of things that are consistent with both strategies is, as Jeff says, there's a huge volume of people who will always require accommodation. Apply that to the student market. There's 55,000 students in Nottingham, so they do need to be accommodated somewhere. The main difference between the 2 strategies is the single let model of adding value or buying discounted is to generate the significant lumps of capital and momentum invest if you can raise finance, like Jess said. What we're doing is primarily focusing, whilst there is a capital value in the properties we're purchasing, we're quite often paying market value for the property, doing a refurbishment to turn it into a HMO, and then really benefiting from the cash flow. So where you're looking at yields and return on investment, we don't get anywhere near the capital that Jess will generate through the capital generation model. We'll very much focus on cash flow. So while there's not a huge added capital value, the cash flow we're looking at is netting between £500 and £1,000 per month per property. One of the benefits there, because we're looking at the cash flow, use alternative models. The single let properties that Jess is purchasing, they are becoming harder and harder to get a hold of because the demand for those has gone up. That's reflected in lower access to stock, but also the prices are starting to creep up. So that sort of stock that's impacted our model using those properties. What we've done is looked at alternative options like rent-to-rent and lease options. So what we'll now do is look at properties that we can control, ideally with the option to purchase to benefit from that long-term capital growth, use our management systems to turn them into HMOs, and then just harvest the cash flow off them. So that's two of the sort of similarities and differences of the models. Applying that to Nottingham and the student market, the amount of students I don't think has changed in Nottingham. There's still 50,000 plus students. The big difference is, the huge difference is, Article 4 came in 2011, which stopped residential landlords in the majority of areas turning residential houses at T3 into HMOs, C4. The council then moved all of their offices out of the city centre, leaving huge office blocks. The permitted development right came in to turn office into residential-ish properties, and the developers have come in and literally, I mean, without exaggerating, put blocks and blocks and blocks of these student-built pods that we've seen in the magazine. These pods that people have invested in are everywhere. We've tried to find out the numbers, and there is a report coming out soon by Unipol publishing a report that they've commissioned about the actual impact this is on the market. And no one knows for sure. There's a lot of smoke and mirrors trying to cover up what's actually happening, but there's a huge shift in the supply of single pod type student accommodation. So that has had an impact. The immediate impact has been the peripherals, the areas that are slightly further out. The purpose-built pods are now more attractive and putting all the students into the city centre. So the outskirts have experienced a shift. So there's higher voids. The landlords that haven't kept their pencil sharp or are still aspiring to these high rent rates of maybe.
Okay, we just lost Dan again for a second, but Jess, I'm just interested to hear your input on that, because these student pods, we've seen them popping up everywhere, haven't they? And we've had quite a few people write into YPN about, are these a good investment? Aren't they a good investment? Dan, I was just referring to the student pod investments you were talking about there. They're cropping up in every town and city because, as you say, the developers with the backing of the universities changing commercial buildings into these student pods. I'd be interested to hear your thoughts on that, because I have some strong opinions on them. I would have some very real concerns about an amateur investor putting a lump of money into those kind of student pod investments. Jess, what are your thoughts on that?
I've never really looked into it. I would say, Dan, of course, you're absolutely right. I've seen that they are popping up all over town, and when you've got the option as a student, and quite often it's not just the student, don't forget, it's the mums and dads that are paying for it. They're the ones that are going to come and look at this place. You can live in a 4-storey down to Victorian terrace in a dodgy little area that hasn't been looked after at all for the last 20 years. Built hotels
From the
investor's point of view, yield-wise, well, if you own the whole lot, I think it'd be alright. If you're looking at just buying one unit in there, I don't see a resale market. I suppose if you just got cash in the bank and you want to swap between your bank account and that, then maybe. But it's I don't know how they securitize it. I don't know if you can get a mortgage on these things.
I don't believe you can. I think they are, as you suggest, I think they're cash-only purchases, and the resale market is very questionable, isn't it?
Yeah. I can see how they work, in terms of the yield. But I'd want to own them all. I'd want to build a block, and it's quite a high yielding. I can see that there's a lot of demand for it. Students will come away from, the traditional area in Nottingham is Lenton. It's one of the traditional areas where the students live, and I can see them moving away from the periphery areas. I think the core is still there, but they're moving away from the periphery areas, the edges of Lenton, to those boxes, and I can see the appeal from their point of view, but as an investor, no, I can't see it.
Yeah. Okay, so we'll just try and get the guys back on, because I had a really specific question to ask them with regard to that. It's certainly interesting times, though, isn't it? I mean, I can see from your model, Jess, you know, the family market isn't changing particularly. It's a bit more stable. Guys, I was just going to ask, Colin, you head up the sort of letting side of things. So, are you finding that, you know, properties really do have to be in that sort of, for the student market, the premium locations if they're going to let quickly now?
I think there's two things that you have to focus on. You've got where the location is, which has always been important, whatever type of tenant profile you're looking to put into a property you're looking to purchase. But then there's also the lifestyle factor that comes with it. There's always going to be a demand for people who can afford it. For large HMO houses, because students like to have house parties, and you can't do that in these blocks. Another consideration is having first years living next to third years. The way they spend their time is fundamentally different. So I think there's always going to be a demand for good quality housing in good locations. What people are starting to struggle with in areas in Nottingham like Hyson Green, Forest Field, St Anne's is the trade-off of those that are price sensitive. Why would you live 20 minutes outside of town in a questionable standard of property when you could live in a brand new pod in the middle of the town for more or less the same price? I think they're the properties that landlords that we've spoken to are starting to struggle with. But there's always going to be a demand for good quality HMO housing in the right areas.
Okay. Excellent. Yeah. And can I ask about the, you know, we've spoken briefly about the two models on the sort of buy to let, you know, whether it's single let or multi-let. Are there opportunities at the moment for buying, developing and selling, you know, has the market reached a point? Because it's something we've probably all been avoiding a bit for a few years, or certainly been a bit nervous about. Have things changed significantly enough for you to be, you know, confident in the sort of resale market in the moment? So Jess, first of all.
Confident, no. But it does. I've done in the last year. We've done just 7 or 8 of them, I think. And there are particular areas where it's the family areas. And it's not. It's a different house to the houses that we're buying to keep. We'll buy a house. We'll do it for a different specification. We won't. It's not it's pretty bog standard our spec for a house to rent out. We make it significantly nicer for a house that we're going to sell. Like I say, we've done 7 of them in the last year. I also people want them. I mean, clients of ours, they come say, I want to do a buy to sell, and you know, the opportunities are out there, so we do get involved. But I always make it really, really clear them before they get involved. Say, look, there's certain things I can control. I can control the purchase. I can make sure we get it more quick, and I can control the agent. So it is our house. The refurb I can control 95%. There's always something that you might have put down to a contingency. At least I can tell you what the contingency should be, and I've never spent more than the contingency. I can then tell you roughly what I think it's going to fetch, and we don't get that too far wrong, to be absolutely honest. But the one thing I can't control is how long it's going to take to sell, and once we've sold it, subject to contract, will it actually go through? I've only had one that sold to the buyer that bought it first. All the others sold, and then 2 weeks later or 2 months later sometimes something else happens, always with the finance, and the other buyer has to, the buyer pulls out. And that's happened on almost all of the properties that we've bought. I have to say it's not always bad. Almost always we've resold it for more money. I'm just racking my brains there. We've resold it for more money. So, we sold one for, I can't remember, 119 or something like that. It fell out, and then we sold it 2 weeks later, literally 2 weeks later, done, for 125. So it wasn't a bad news story. It's just the guy who had bought it, added the value, and then to sell it, he had a 9-month wait. wasn't a bad return. They made 20 grand in 9 months. It's not bad. You can't pocket it, but it's not predictable. One thing that we are doing now is a lot of our clients who buy the buy-to-let stuff, they're using more bridging finance. And we worked out that the people that do buy-to-sells they're looking for a stable return. They're looking for a rental return. What they tend to do is buy the house, do it up, sell it, and then work out their return over the months they've held the property and say this is a 6% return, or actually it could be a 12% return, depending how long it took to sell the thing. So what we found is a lot of our clients that wanted to finance a project to buy to sell are now saying, well, why don't we help your clients that want to buy to let to finance their property? So instead of them going to a bridging company, we'll lend them the money, give them a fixed return, and what they end up with is the people who want the return, they get the fixed return, and our clients that are buy to let clients get bridging finance as well, which is at a better rate, because bridging finance is expensive. The reason it's expensive is because of underwriting, and the people lending the money generally don't know who the person is that's borrowing it, where the house is, whether they're really going to do it to a good standard. Whereas if they're investing it through, they do know that I know the client, I know they've got the deposit, I know they've got the money for the refurb, and so that's people who want to do a buy to sell now. We encourage them to put their money into that instead, because it's just a better return. I'm saying that there are sometimes when it's a bargain. Sometimes it comes along and you can't say no, but I've done two in the last year. So.
Okay, well, one of the interesting things on that, Jess, is that, and I know we've talked about this before because we followed sort of similar models, is, you're talking about bridging finance, and I think it's worth explaining why on those types of properties that it's a very, very narrow band between being able to add value and what is a mortgageable property. So that's why we're talking about either bridging finance or private finance of some sort coming in to enable the purchase. So, Dan, I'm just going to ask you.
I think bridging finance is going to become more.
Sorry, Jess. I was just Dan. What was your thoughts on the sort of buy to sell opportunities that Nottingham affords at the moment? Jess has highlighted some of the issues, maybe a couple of the opportunities. Okay, don't know quite what's going on with the guy's connection here. I almost said a very rude word there. But we're recording the call, so I stopped myself. Guys, I was just saying.
Yeah, I think I've got the question, Anne.
Yeah, come on, I'll leave you to it.
Yeah, the biggest thing, the single thing that we have the biggest issue with, we've got excess, we've got huge demand, the market environment's good for lettings, we don't have any trouble filling our rooms. We've got excess amounts of capital from investors all around the UK to invest. The biggest problem we have is completing on purchases, is getting the purchase over the line, whether we're bridging, whether we're buying cash or using a buy-to-let product. The hardest thing is getting them over the line. We've got 6 purchases going through this month, and there's just no sign of them completed. You just don't know whether it's going to take 3 months, 4 months. We've got one from last month that took 5 months to get through. Actually achieving the purchase is hard, and you can only assume that the contributors to that, including mortgage companies, solicitors, the issues that they're having apply to buy and sell. We're not trying to sell aggressively. We've got one unit at the moment we're trying to sell, and we've been trying to sell that for a year. And it's sold twice, and it's just fallen through. Mortgage lenders not lending. I suppose the caveat there is it's hard to sell a residential house. Essentially, it's 10 times harder to sell a HMO because there's 2 or 3 traditional lenders in the market that will finance. So I'd say the process of buying and selling is incredibly difficult. And in the last 18 months, we've gone from 0 to 145 rooms. So we've been expanding very aggressively. There's no way that we could do that with a purchase model. So we have to complement it with rent to rent and lease option. That's the only way we can achieve the level of expansion we want, because whilst the market looks encouraging, it's only going to get harder, and solicitors just don't appear to have the capacity or the model and systems in place to complete quick transactions anymore.
Okay. Dan, and can I talk, you mentioned the sort of Article 4 earlier on, and I'm guessing that is really had a huge impact on buying your standard sort of residential house and then converting to a suitable HMO. So your model has gone down the route of, taking control of properties within which are already established HMOs, so therefore Article 4 doesn't come into effect for you? How does that work?
Yeah, well, Colin heads up our Nottingham office, and Nottingham, the 3 offices we've got, Nottingham's the only office which is subject to the Article 4 restriction. With every...
Okay, we'll try and get Dan back. I'm not quite sure what's going on with the guys there. Okay, sorry, let's try again.
Back?
Yes, you're back.
No problem. Yeah, with every problem, so the Nottingham office, the barrier it's experienced over the last year is Article 4. That's been complemented by this huge shift that we're talking about in the student market. The opportunity for us there is that we can't turn residential houses into HMOs anymore. That's granted. We appreciate that. And this huge shift in the student market has meant there is an increase in volume of voids, vacant property, which is our existing HMOs that just aren't suitable for students anymore. So we've created a model where we're joint venturing with existing landlords with portfolios who've already got the established use, the Article 4, the C4 legislation, C4 certification, so we can use their properties, and we'll take those on either a rent-to-rent or more traditionally or more common in the Nottingham area on a lease and with an option on the end. We'll get them up to the standard they need to be, and then either re-let them to students or key workers and professionals.
Okay, brilliant. Now, guys, I want to talk about Nottingham in general for a minute, and something which, I hope you're going to forgive me for, okay, and that is that Nottingham used to be in the press a fair amount when it was referred to as Shottingham. And like every town and city across the UK, and believe me, I have it where I invest as well, there are areas which have genuine problems, and if you were a kind of novice investor going into these areas, you might be very, very attracted by the purchase prices, but there could be good reasons to steer clear. And I tell everybody, whenever I talk at an event or when anybody who's willing to listen to me, that Weston-super-Mare is Drug and Alcohol Rehabilitation Centre of Europe. It comes with its own problems. They don't put it in the tourist brochures. So, Jess, you've been in Nottingham a while now. Can you tell us a little bit about, your thoughts behind the city? Maybe there are areas which, might be best to avoid, unless there are, opportunities there and you go into it with your eyes very, very wide open.
Yeah. Well,
I'd say that
a flat for £12,000 like that. So there are areas in Nottingham I wouldn't invest in it at any price. So this flat was, to put it politely, your only tenant would have been a drug addict or a prostitute, probably both in the same person, to be honest. It's just not somewhere. It's just hassle. So we will always buy outside those areas. So if you were to mark Nottingham or any place on, give it a number for the score. So that flat would have been in area 1, and Millionaires Row is area 10. We always try and buy in areas 3, 4, and 5. By the time you get past that, maybe you start to lose your yield, but that's where we're looking to buy.
So, Jess, can you name a few areas? If anyone...
There are places where we wouldn't buy. Having said that, Nottingham, I that many places. Every metropolitan city has got somewhere where you wouldn't invest. But I've looked at other places, and Nottingham's not that bad. That's it was a Sun headline actually that said Shottingham. I think it was in the 1990s, and there's not actually that much gun crime in the whole of the UK, never mind Nottingham, so 1 or 2 shootings, put the percentages up, that's pretty good. I think there was one guy, in fact, I was earlier on, I was mentioning, there's a particular area in town where we bought quite a number, there's a few areas where we bought, but one of the streets I was actually referring to, we bought some quite really, really cheap properties, and the guy who did those shootings, he lived around in that area. I was always told, don't buy around in that area, it's where the problems happen. I bought loads in that area, and I can tell you that they are some of the best, they're bumped up, because the guy's in prison. And it was one guy. I mean, there are 20,000 chimney pots in and around that area, and the problem is long gone 20 years ago, but still you had that stigma, which I think is disappearing as time goes on. There's probably 3 generations, maybe in some of the areas where they might have had time for 5 generations in some of our towns. But yeah, it's an opportunity in that, I think. We bought them for 30 grand in a slide, and they're worth 80, 85 now, so numbers. Buy on the street, like literally buy that house. What does Sun know? What does a headline tell you really? Not a lot. Actually, you've got to go around, walk around. It's not a bad area. I've been in lots worse areas in Nottingham, therefore it's
yeah. Okay, so let's get Colin's thoughts on this as well, because someone who knows the city well. If I was to rock up, with my suitcase full of money, saying, I'm going shopping in Nottingham for some places to live. Look, let's be honest. Where are the places where you would suggest that it might be worth avoiding if I don't want to end up in the very worst areas? Can we name a few, Colin?
Yeah, I mean, one thing I would say is that there's no bad areas. The bad areas are the ones that don't stack up. It depends who you're going to put into these houses. If you're looking for sharp-suited professionals, then you would avoid areas like St Anne's, Bestwood, and certain parts of the Meadows.
Right, we've lost the guys there, Jess, so I'm going to get you to answer that question, if that's okay. Any particular areas where you think...
Colin's absolutely right. Yeah, I think he's right. It's dangerous to name the area because there's nowhere that's particularly bad. The flat that I was talking about is in a place called St Anne's. It's at the bottom of the city, so it's very close to the city centre. But if you were to say don't buy anything in St Anne's, you'd be wrong, because St Anne's is a long, thin district, if you like. It goes from the bottom of the city centre about 1.5 miles up, and at the top of it, it's almost Mapley, and that's one of you get in Mapley, you're probably on you've certainly got a part of Mapley that is Millionaire's Road. So you can't just say the word or the name of an area, and that will have you covered, because I have a lot of people, a lot of our clients who have done a bit of research and say they come to see us. We do an investor day where we take people around all of the areas, and before they've seen Nottingham, they've done a little bit of due diligence on it, which is good, of course it's good. And they said, well, we don't want to buy in, and they reel off a number of areas where we buy. And can't do that. And by the time the day's out, we've taken them around, we're getting minibus, and we go around the areas, and I can point out areas where you say, that is St Anne's, and you say it's St Anne's, and you can see why we wouldn't buy over there. But look, we're going to drive a mile up here, and it's completely different. I mean, we've crossed 2 main roads, and we've gone up a hill, down. We're in a different area. It's completely possible to drive to a £2 million house in Nottingham, zero the odometer, and drive a third of a mile to a place where you can buy a flat for £12,000. You can do that. And you wouldn't buy that flat for £12,000, and it's only a quarter of a mile. So you've really got to know your area, and avoid the sweeping generalisation, I think.
Okay, I mean, this is...
Essentially,
I was going to say, it's interesting, in every single one of these calls that we've done now, people have said, you know what, it's not about the area, it's about the individual street or the group of 20, 30, 40 houses within that area that, you know, you kind of want to avoid. But as you say, you know, it's not right to name certain areas because they vary road by road, or, you know, 200 yards, 300, 400 yards in either direction can make a world of difference.
Yeah, you want a little buffer. If you've got a real terrible place and you've got, you need a buffer, you need a gap. You know, if you're talking the difference of 100 metres, I don't think that's enough. You know, as people say, oh, one side of the street is better than the other side. I think that is actually pushing it a little bit. If you've got something that's you couldn't buy on one side of the street, if you're telling me on the other side of the street you would. Now, round the corner, down the hill, just give yourself a buffer between the one you wouldn't buy and the one you would buy. So we wouldn't buy in an area 1. You probably wouldn't buy in an area 2 then, because you need a bit of a gap and a bit of space between it. But Nottingham's called the City of 7 Hills, so you can go over the brow of a hill and be in a completely different place.
Okay, brilliant. So let's just talk a minute about your individual businesses and how, if anyone's listening to this or reading the article, they can work with you. So, Dan and Colin, any investors out there where they're thinking about Nottingham, perhaps they've read that, you know, the yields can be really good, how can they work with you guys?
I'll say for people who are looking to invest in Nottingham, it's definitely a great city. There's all sorts of markets. There's the professional student market, HMOs that we do. There's the single lets and the B&B stuff that Jeff does. I'd say it's a good city to invest. I'd say there's a majority of markets up here. I wouldn't be able to say explicitly, but I probably wouldn't rush towards the purpose-built blocks until the dust settles and we see what's actually happening. I'd say the biggest thing is to make sure, if you are remote investing, assuming that the people who might be attracted to Nottingham are listening to this because they don't know Nottingham, I'd say choose the investments that stack up and that give you the value you're looking for. But just make sure, whether you do work with us or with Jess or with any of the other companies, make sure that they've got the management systems, the experience and the structure in place to take that investment from paper to continually and sustainably deliver your returns. It's all well and good getting the deal across the line, but it really is the management and actually servicing that relationship afterwards. So whether investors want to work with us or someone else, I'd say that's what they really need to be looking for.
Okay, so if they were going to work with Pulse, we'd be looking at what sort of HMO investments where an investor would be, you know, putting a reasonable chunk to deposit in, but generating a cash flow from that. Is that the kind of model that we'd be looking at? So you'd be looking with people with capital looking to create income. Is that right?
Yeah, certainly. Our business is focused on cash flow, so salary replacing income. That's really what we focused our company on. The investments that we work with our existing clients would be package deals. So we'll put together a HMO, we'll tenant it and then manage it moving forward for a fixed fee. We do joint ventures, so we do like a profit sharing model where individuals will do a joint venture. The individual will purchase a property, we'll then manage it, and there'll be a profit share based on the level of capital that's invested.
Okay, brilliant. Well, I think the guys are kind of really wound up now, Jess. So with yourself, again, a couple of different models where people could work with you, which you've sort of alluded to. Either it would be on the sort of portfolio building service following your own model of buy, add value, refinance, be generating a monthly profit and move on to the next deal. But also you mentioned earlier on, if people are perhaps wondering about doing buy to sell, then maybe a better way of sort of supplying funds for your clients to buy with. Is that right?
Yeah.
Okay. No, I was just going to say, I mean, you know, we've known each other for a while now, Jess, and, you know, we follow relatively similar investment models, and you're not going to retire off 2 or 3 single lets, are you? That's just not how it works. But this is a sustained wealth creation model.
Yeah, almost all of our clients are forcibly remote. 80% of our clients are southern based, over a 2.5, 3 hour drive away. Some are in different parts of the world. So the service we offer is totally hands free. We term ourselves the investor's estate agent. So we don't sell you a property, we find you one to invest in. And for a long time, for the last 3, 4, 5 years, we have been concentrating on, we've been a one-trick pony, being totally honest. We've been a 2 and 3 bed family house, because I couldn't see anything else being reliable enough to put clients into. What Dan was saying there about getting things across the finish line, it's absolutely the case. You've got to make sure that you buy it. Sale agreeing it is the easy bit. You've got to get it through all the different stages. You've got to get it rented, and then if you want to refinance, you've got to get that bit done as well. And the 2 and 3 bed single let just does that, and has done for the last couple of years. We're now starting to do other projects. It is getting harder to find a £50,000 house, but I do think it's getting easier to find a block of flats. We started buying blocks of flats again. I used to buy blocks of flats in the 2005-06 years. Back then, I'd buy them, do them up, and revalue them individually with individual mortgages. You can't really do that anymore. The mortgage companies, they wouldn't let you. They've got all sorts of exposure rules where you find that they just won't. There's only about 5 different lenders out there, and they wouldn't really lend on the properties. But there are ways of doing it. Lloyds will still finance that kind of deal, and a couple of semi-commercial lenders out there that will. We can buy a flat for 40 grand. We can buy it in a block of 3 or a block of 10. We're buying a pub at the moment, converting that. We're buying a block of 10. They're already converted. They're already flats. It's just they're quite tired and grotty little flats in a nice area. We'll buy them, do them up. It's exactly the same model. It's just we're doing it with a block of 10 flats or a block of 3 flats or whatever. So that's something that we're growing into. I've just put a couple of HMOs together for myself, actually. I didn't buy them as much as such. I had the space spare above a shop. I've got a couple of commercial units which had a space above it, so that I rent the shop out downstairs, and the space above it was wasted, and I just put 6 rooms all with ensuite. They've gone really, really well. And if I could finance them, I think that's something that clients will be interested in. So that's something that's going to come along as well. But so basically, as the market's moving and finance is becoming more available, and like I say, as our business is growing up, we've recently moved into a new office, and I've got a buyer. We've got our own building company. We've got 70 odd guys out there doing building work at the moment. I've got a works manager and surveyors and those kinds of people that are helping me out. And we've also got a letting agency here as well. So everything under one roof, and that's, as our business has grown up, we're able to offer more different products easier. It's would have been quite a big task for me to take on a block of 10 flats a year ago, redevelop them, get them all rented out. I'd have basically been doing it with myself, with 1 or 2 others, and now I've got a team, 13 or 14 people to help me out. So it's kind of some of it's the market moving it, some of it's our business moving as well, I guess. But there's definitely a lot of opportunity out there in Nottingham. It is the second fastest growing city in the UK. The fastest, of course, is London. But the pay to play in London is so much higher. In Nottingham, you can get involved with us. It does take cash. We don't do no money down or anything like that. You can get involved with us for as little as £25,000. That will get you a deposit, all our management fees, and a refurbishment of a property in Nottingham. Typical property would take a cash pot of between 30 and 40, and the guy in a moment who's just about to invest nearly £2 million. So that's the scope of what we're working with.
Okay, brilliant. Well, look, we've had some technical challenges with Dan's side this morning, and so Jess, thanks for sort of sticking with us. And it's been a challenging one, this on the technology front. But I think anybody watching this gets a good understanding of the city. Some of the opportunities there, perhaps some of the pitfalls as well. Some of the investment types that are being promoted there at the moment that they really might want to question. I know we started talking about the student pod side of things. So we're going to include all of your contact details within the article that goes into YPN. So anyone that watches this can get in contact with yourself, can get in contact with Dan. I know you do some discovery days. We need a couple of things from you guys, if that's okay. So Jane will need some example deals with some pictures as well that we can get included within here, and I know that won't be a problem. So we're going to email today on those, if that's okay. So a very personal thank you for putting up with the technology side of things today. It's been a real challenge, and thanks for sharing your thoughts on Nottingham and what it's like to invest there. Much appreciated.